So today, as always, we're going to do a review of DraftKings earnings. They've just reported the Q4 earnings, and as always, I put all the good bits from the earnings report down on the whiteboard and we'll go through it together. Now, just a little shout out, this will be my last video until Monday, so if you do want to see some exclusive content over the weekend, I've just dropped my UK portfolio review for February, and as well as that, I'll be doing some other portfolio reviews on the Patreon, so if you do want to join, link in the description, only £5 a month. But DraftKings earnings, so we've covered the full it's still only like DraftKings and Hims and Hers, it's the kind of two earnings that I do a full breakdown on and point anything out that I noticed in the earnings. We've done this for DraftKings since I've owned it, which is probably around about 2 years now, maybe even a bit longer than 2 years. So yeah, it was the crazy thing to say is that it was the most muted response on the share price that I think I've seen DraftKings do for a long time. We either have the stock going down massively or we have the stock going up massively. So the fact that the stock is pretty neutral today is something that we're not used to seeing, which is quite funny. But it does mean that as we're recording this video, the stock has opened up a little bit higher though, so that does mean it has put in new 52-week highs once again. It's been a very good stock to own, and it is now up 33% year to date. So if you saw my preview, which was on Monday, I said in my opinion, I think the earnings will be good, and I did think they were good. But my big worry is that it's just run up so much before earnings. I thought that we were going to have a little bit of a cooling off phase, and when they did report the earnings, there was a little bit of a drop in the market. Conference call happened this morning, and it was a good conference call, really good conference call as always from Jason Robbins and Jason Parks, and maybe that's what got the good talkers, so maybe that got the share price up and into the positive, and that's why today we've once again pushed to new 52-week highs and 33% year to date. I mean, crazy. You know, when you back a stock like this and you make it your biggest position, you know, you do need it to perform, and obviously probably one of the reasons why I outperformed the market massively in last year, and obviously one of the reasons why I'm outperforming the market this year is because of this guy and the gains that it is doing. But I've got to say, at some point I do feel like it's got to have a cooling off phase. But what I will say is that this earnings was about a year, 2 years ago when I started doing these full earnings breakdown. For any of you guys that have been here since that time point, you know, well done to you guys, shout out to you guys as well. Any of you that have held the stock through that time frame, you know that this was a misunderstood stock. People weren't listening to what was going on inside the company and listening to the revenue growth and how the revenue growth was still exploding on states that had been mature for many years, and also they weren't listening to the path to profitability, and that the only reason why it's unprofitable at the moment is because so many new states have launched. Once these states hit maturity in 2 or 3 years, which it has happened now, we'll see the profitability start to move up rapidly, and we've had that in 2023. Once again, I think people are starting to listen a little bit more now, but I think people are still missing the story. This earnings report was a basic snapshot into 2024, 2025, 2026, and Jason Robbins and Jason Parks was saying, hey, you know, that profitability now is going to scale rapidly. This is now not a company that is just on how fast it's going to grow, which by the way, it's still going to grow fast. But people weren't listening to the profitability numbers. The profitability numbers that this company is going to start throwing off are going to be impressive, because what we have now is we have a company that's basically got a fixed cost. They're not having to scale up the projects and technology. The G&A hasn't really had to scale that much. Sales and marketing isn't scaling that much. But what you have now is you have the states that are just continuing to grow and grow. And when a new state comes online, they basically have a model now where they just drag and drop the model into the new state. They're already advertising there because they're doing national advertising now. And that state just basically straight away adds to like the revenue and profit drive. So you have a company now that is not where it was a year and a half ago, where it was misunderstood on how fast it will grow and how that profitability will move very quickly in the right direction. We now have a company that is put in a place where it's now going to scale up to major amounts of profitability. And that profitability will show in 2024, 2025, 2026. I don't think people are realizing that. And then when you start working on the profitability numbers that they're going to be doing, it actually looks not that bad of a valuation, which is quite scary to say. Anyway, let's get on to some of the numbers and things that are going on inside the company here. So, new 52-week highs, obviously not a crazy jump, but obviously great to see. 33% year to date, obviously really good if you own this stock. It's a stock that's outperforming the market. It was a quarter that was hit by sport betting outcomes. Now, Jason Robbins said that this was the worst outcomes. The last 2 weeks in November was the worst outcomes they've seen since being a public company. The outcomes were not good, and I think if you remember, I think I made a video on it back in November saying the outcomes for the sports betting companies, and we saw it with Flutter, haven't been good. So that's going to happen. We're going to have that at some point. We had very good outcomes recently. And also, from a customer point of view, you do want them to have some weeks of good outcomes because otherwise they're not going to come back. So yeah, it will balance out in the longer term, but this was a quarter that did get hit by that. They said that it cost them 175 million in an EBITDA loss, which with that, the EBITDA would have been insanely good. I believe the company would have actually been profitable, and the company, obviously from a revenue point of view, would have been a lot higher as well. So yeah, if it wasn't for that, this quarter would have been absolutely amazing. It would have been another, we've got so used to DraftKings absolutely smashing it that when we get a good quarter, we were a little bit disappointed. I think overall, I'm giving this quarter 9 out of 10 just because of the outcomes that we've had this time. It was going to happen at some point. We've had amazing quarters that we can't keep staying up them heights forever. We were going to have eventually one of those quarters where the outcomes doesn't go in our favour, but it'll balance out in the longer term. And that I'm going to give this quarter a 9 out of 10 just because of that. If it wasn't for that, it would have been another absolutely insane quarter from them. But what was given in the quarter was really good information about the longer term, which got me excited for the longer term, which is more important than what's just happened in the last 3 months. It's definitely where's it going to be in the next 2 or 3 years, which was good to see. Non-GAAP EPS 0.29, beat by 0.11, insane. Really good. I said the big thing that realistically now revenue isn't an issue. We are looking at the company now to scale up the profitability. That's what the company going in 2024, 25, 26. The company is going to do very well with the growth. However, whatever if the growth comes in at 2, 3, 4, 5, 10% ahead of expectations, Wall Street isn't really bothered about that now. The path to profitability is what DraftKings is on now. So this being here was the more important number, and they delivered massively on it, which is really good. Revenue up 43%. They did miss by 10 million, which isn't a major issue. MUPS was up 37%. I think any worries around the competition of ESPN coming in kind of got pushed to one side here. Clear that the product that they have and the scale they have at the moment and the user acquisitions they've got is very impressive. That was good. Average revenue per monthly user was up 6%. They still continue to increase it. What was actually even more scary is that without the outcomes, and this is the big thing, this outcomes has weighed so much on this quarter, but yet we're still talking about very good numbers. If it wasn't for these outcomes, imagine how good this quarter would have been. But if it wasn't for the favourable outcomes, we would have actually had it up 22%, which is obviously really scary to see. They did upgrade the revenue and the EBITDA guidance, which I haven't put down here, but I think on the high end, that does mean the revenue now is going to grow at 34%. Like I said, I think we'll see that definitely go a lot higher as the year goes on, but yeah, that's good to see that they're hiking up the guidance already in the first quarter. Seems like the suggestion is they've already seen a very strong Super Bowl, and even though once again the Super Bowl outcomes didn't come in their favour, it actually hasn't had much impact in them, is what they were saying on the conference call. When you look at the scope for the business to still spread, they still are at 46% of the population in sportsbook. Like, we're not even halfway there yet. So the scale and the growth story is still crazy. Like, we've still got a good 5 years plus of 40+% revenue growth still to come, which is scary. The other scary part is iGaming. I think 11% of iGaming is what we have active at the moment. So iGaming, people sleep on the iGaming side of the business. That's got so much scale to still come. And I think with the elections that are coming up as well, I think it's 10 iGaming bills, one of them being New York as well, which obviously would be a really good one because obviously we've already been in the sportsbook side of it. I'm sure iGaming in New York is actually on the bill coming up as well, so that could be a big growth driver coming up as well in the future. North Carolina is going to launch on the 11th of March, so we're going to have another state coming online. Losses was a massive improvement, 44 million loss to 242 million, from a 242 million loss. So we are very close now to moving up to the profitability side of it. If they are scaling up these losses to profitability, we're going to see the company profitable by on a net income basis will be profitable in Q4 next year. I think if we had better sports betting, they didn't say this, but if we did have better sports betting outcomes, I wonder if we would have hit profitability. EBITDA went from a 49 million loss to 151 million EBITDA gain. So once again, we're seeing all these numbers now drag up closer to either break even or profitability from an EBITDA point of view, which is great. All moving in the right direction. Stock-based compensation went down once again, 130,000 down to 113,000. Really good improvement there. Probably the surprise one, which was Jackpocket. They bought for 750 million. So we'll have a quick look at that acquisition and that press release that they did do. So looking at the press release, you can see here DraftKings reaches agreement to acquire Jackpocket for 750 million. They expect to drive 60 million to 100 million of adjusted EBITDA in financial year 2026. Looking at the moment, it's not going to close until the end of the year, so that would be a good turnaround if they can do it with the business. You can see here that also from a revenue point of view, they're expecting to drive 260 million to 340 million of revenue by 2026 as well. So yeah, I think overall, I think the company currently makes around 70 million-ish or 78 million at the moment, and they're expecting that to grow to 135 million in 2024. So yeah, originally I made a mistake on the Discord on the Patreon because I said, oh, I think they've overpaid for this. I actually looked at the wrong business. So looking at the numbers at the moment, I actually don't think this is a bad valuation that they've potentially paid for Jackpot, especially if they're able to bring these numbers out that DraftKings is suggesting. Now, obviously, we'll judge that in a few years' time if the acquisition does go through and if they do them numbers. But ultimately, my thoughts on this is that originally, when I saw it, I was like, that doesn't make sense, why they're doing that move. But the more I looked into it, I actually thought, this is a really good move. Now, first of all, we've seen DraftKings make 2 previous acquisitions, obviously Barstool Sports as well, which is going to happen soon, but we've seen them make, I think it was Playtech they bought, which was a really good move because then they brought all the technology in-house, which has served them very well. That's helped them become the number 1 sportsbook. If they were to sell that on from what they bought it for, it would be more money. So that first acquisition they made has been a really good one. The second one was GNOG, and once again, that's been a really good acquisition for them. So DraftKings and Jason Parker, Jesse Roberts normally get the acquisition calls so far right. So that's a really good thing when we've seen them make them. They've turned out to be really good moves. The other thing is that what they're probably looking at this from is that originally DraftKings had the fantasy page, and what they were able to do is that they had all those users and all that data already, that when they came a sports betting platform, they just went, hey, we send all that information about sports betting to our users, and that's how they became the number 1 provider. So having the fantasy sports before the sports betting platform helped them. Now having the data from the jackpot on the lottery side of it, and buying this lottery company, they're going to have all this data to all these lottery customers, and they're going to be able to get them to onboard onto the sports betting and iGaming side. So they're probably using that data as an upselling point of view. The other thing, and the big point here, is that the lottery side of it compared to an iGaming or sports betting is allowed in a lot more states. I think it's currently 45 states they're currently allowed in. So while they're waiting for all this down here, all the sports betting to go up to 60, 70, 80%, while they wait for iGaming to go up to 20, 30, 40%, they can use all this national advertising at the moment to push them onto the lottery side. So they get revenue and profitability now from the customers they currently can't access while they're waiting for these states to come online. But then they use it as a data collection site. And when they do come online, as well as already having national advertising there, they also have a product that they already have there and try upsell to their customer base and do that cross-sell over. So it gets them into a new industry and also gets them into customers they currently can utilize a bit more. So when I look at this move from DraftKings, at first I was like, why are they buying a lottery company? And then I looked at the cross-sell over potential, and also the potential of getting the customer data early on, and that's what gave them the success with like the fantasy sports and then the sportsbook early on. And for 750 million, if they can do those numbers that they're suggesting there, which we'll see, but even if they can't do those numbers, it probably will, for the money they've paid up for it, is a good acquisition. And also, I thought the way they did the deal was really good. Half it through adding on shares, which is good when it's at this sort of level, and the other half by paying through cash as well. So it's not a big dilution either, and you're not burning through the cash pile. So really good move from what they paid up for it as well. Now, what also makes that deal very good, and I think people slept on this on the call a little bit, is that, like I said, the cost structure is in place now. The costs aren't going to go much up for the business. So as the revenue goes up and they drag more to the bottom line now, because the costs are going to stay the same, they're now going to be dragging up the profitability. They're now going to be dragging up the EBITDA. They're also going to be dragging up the free cash flow. And because they're going to be making so much free cash flow next year, they now have this cash. And because of that cash, they can go make acquisitions. They said their cash pile by the end of this year, 2024, will go, I think it's currently at 1.1 billion. It's going to go up to 1.6 billion by the end of the year because they're now generating cash, which is really good. They now have that much cash to play with, which is insane. Now, they said that they're going to look at how they're going to return that to shareholders. I think this is one of my suggestions. In 2025, so we'll have to wait this year, but in 2025, I believe DraftKings will buy back shares, which will be really good to see. So that's something to keep an eye out for in 12 months' time. We'll come back to that. Because they're generating so much free cash flow now, that's what they'll be able to do and reward shareholders. And obviously, cancel out the rest of this stock-based compensation, which would be really good. Next thing, and this wasn't on the conference call, but this is my suggestion, is that now the profitability is scaling up, we probably won't have 2024 a year where, so to get into the S&P 500, they have to do 4 positive quarters of earnings. I don't think they'll do it next year. I think we will have 1 quarter next year. I don't think it'll be 4 quarters, but we'll have EBITDA positive and cash flow positive. What will happen probably in 2025 is in my opinion, unless there's crazy amount of state launches, they're going to probably do 4 quarters of profitability, 4 quarters of adjusted EBITDA positivity, and 4 quarters of free cash flow positivity. It will qualify them for the S&P 500. I think if it's not 2025, it will be 2026. But I think we are going to be 24 months away from the S&P 500 inclusion, which is massive. Because if I said to you when I was doing these videos on DraftKings 2 years ago or 3 years ago, saying that I'm going to be buying a future S&P 500 member, you'd have been laughed at. Now, ultimately, I thought they would at the time. I've always said I believe DraftKings will become a 100 billion market cap company by the end of the decade. That's what I've always said about it. And even if it doesn't become a 100 billion market cap company, I think we'll at least get to a 50 billion market cap company. Now, looking at the guidance they're giving, looking at the scale of profitability that's going up from a free cash flow point of view, from a profitability, from adjusted EBITDA, from the revenue growth, and the potential TAM, the growth they still have from an iGaming, from a sportsbook, from a lottery business as well now, I can quite comfortably say I think it will become a 50 billion market cap company. I think we will see DraftKings become a 50 billion market company in the next 2 years. Looking at these numbers and how fast they're growing and how much that profitability is driving up, it's even more than what I was expecting. I think we will see DraftKings become a 50 billion market cap in the next 2 years, which is insane to say. And it was exciting. I think this earnings call was one that you looked at and it was probably a little bit disappointing compared to the ones that we've seen, but it was still fantastic. It was still fantastic when you look at the numbers. But what this earnings call was, and what these earnings were, was a snapshot into the future. And looking at the scale that they're going to get, they're still going to grow rapidly. But yet the profitability structure that's now in place and the free cash flow they're going to be throwing off and what they're going to do with that free cash flow and return it to shareholders was impressive. Really, really impressive. And it was one of those that they're going to do better numbers that everyone thought they were going to do. And the potential that what this is going to do in the next few years, I always said, like, I think it could become a 100 billion market cap company by the end of the decade. I am looking at what I'm seeing at the moment, I'm very certain it's going to get there. What is more scary now is how far is it going to get into a 100 billion market cap looking at these numbers. If it carries on doing what it's doing, this is going to be a really good return. I mean, obviously it's been a good investment already, but the future, listening to this conference call and the scale that they're going to get to, it's going to be really good. Really, really good. So yeah, I was really happy with the earnings, and not just from an earnings point of view, but what the future is now showing for this business is more than what even I expected 2 years ago, which is great. So yeah, it was impressive. It was really impressive. So yeah, well done to any of you guys that are still holding DraftKings. Well done to any of you guys that bought when the stock was $9, which is crazy to say now. And yeah, really happy overall, guys. Have a great weekend. See you on Monday.